Hello and good evening, everyone. I'm Mangesh Deshmukh from the Corporate Communications team, and on behalf of CareEdge, I welcome you to our today's discussion on C&I Segment, the new growth engine for renewable energy sector, and sincerely appreciate your time in joining us for this webinar. We would like to welcome our esteemed guest speakers for today. Mr. Nikunj Ghodawat, Chief Financial Officer, CleanMax, Mr. Shyam Sharma, Chief Financial Officer, O2 Power, Mr. Mitheel Mody, Head Origination and Relationship, Tata Cleantech Capital Limited, Mr. Nisheeth Khare, Chief Business Officer, Aseem Infrastructure Finance. This session will be moderated by Rajashree Murkute, Senior Director at CareEdge Ratings. We will commence this session with a presentation by Jatin Arya, Associate Director at CareEdge Ratings. This will be followed by a panel discussion and Q&A session. In case of queries, participants are requested to key in your panel. We will take up your queries during our panel discussion session. Now may I invite Jatin to make his presentation.
Thanks Mangesh, and good evening to everyone. The topic for today's webinar is would C&I segment be the new growth engine for the renewable energy sector for India to achieve its target of 500 gigawatt of non-fossil fuel based capacity by 2030. Actually, an annual additional renewable energy capacity of 50 gigawatt would be needed. Apart from the utility scale projects which are supplying power through the central renewable energy implementing agencies like NTPC, SECI, NHPC and SJVN, and the projects that are directly contracted with the state discoms, the RE installations through the open access route are also expected to gain more traction over the next few years. So in today's webinar, we'll try to understand the overall progress we have made thus far in the renewable energy C&I segment, along with the key sector specific trends, policies and the issues. So the content flow in today's presentation includes the following. First, we'll provide some updates on the overall renewable energy sector. Thereafter, we'll also share the latest capacity addition trend for the open access RE capacity segment in particular, the key proposals that have been made through the green open access rules and their adaptation by the various states, the tariff competitiveness that is there through the group captive or the open access route vis-a-vis the grid tariffs that are applicable for the C&I segment, followed by the key drivers and challenges for the C&I segment. And lastly, we'll also speak about the rating outlook, what's our outlook for the sector. So moving forward, just to give a brief background on the sector. So as reflected in Exhibit 1, the total RE capacity of India stood at 130 gigawatt as on June 2023 end, as against 110 gigawatt as on FY22 end. So solar segment is the major contributor in the overall RE mix, with India's solar capacity standing at 70 gigawatt as on June 2023 end. The other major contributor in the RE mix is the wind segment, and the overall wind capacity as on June 23 end stood at 44 gigawatt. But if you look at the share of RE as a proportion of the overall, power generating capacity, that has increased from 14% as on March 2016 end to 31% as on June 2023 end. And this rising share of RE capacity in the overall mix has been primarily on account of the strong policy focus by the government. Secondly, the superior tariff competitiveness that RE seems to be enjoying over the other modes. And lastly, the buoyant investor interest that's been there in this segment. Moving forward, as demonstrated in Exhibit 3, the solar power segment remained the key driver for capacity addition in the RE sector, with significant capacity additions coming over the past 6+ years, which in turn increased its share in the overall RE mix to 54% as on June end, as compared to 17% as on March 2016 end. Despite RE constituting about 31% of the overall energy mix, its contribution in the overall generation, it remains subdued at around 11 to 12%, primarily on account of the lower PLFs due to the intermittent resource availability. And as demonstrated in Exhibit 4, India actually installed 15.6 gigawatt of RE capacity in FY23, which is 3% higher than the capacity added in the corresponding period of the previous fiscal. So going forward, we expect annual installations to catapult to 20 to 25 gigawatt over the next 2 years, primarily supported by a healthy pipeline of more than 75 gigawatt. Moving forward to the C&I capacity space, what have been the installations and the prospects in this space? So apart from procuring power from the grid or through the state discoms, the C&I customers also have the option to purchase power either through a third-party power plant or through a captive or a group captive power plant. While the third-party open access route does not warrant any capital investments from the off-taker, it compels the consumer to pay all the open access charges applicable in the state. On the other hand, in the captive route, C&I consumer owns at least 26% stake in the plant, thereby warranting some initial capital investment. The same is, however, recovered as consumer is exempt from paying two major types of open access charges, that is the CSS, cross subsidy surcharge, and AS, that is additional surcharge, which roughly accounts somewhere between 2.5 to 3 rupees per unit in the key RE states. Till FY17, the open access RE market was a fledgling market, and the capacity installation started thereafter on the back of a favorable state policy in the state of Karnataka. So, as per that solar policy, the solar plants that were commissioned before 31st March 2018, they would be exempt from paying open access charges for a period of 10 years. So as a result, Karnataka witnessed open access RE installations of over 2 gigawatt in FY18 itself, thereby kick-starting the growth in this subsegment. However, from FY18 to FY21, the installations actually remained subdued due to some of the key states withdrawing the open access benefits, as state discoms would face revenue loss due to transition of their high-paying customers to the private players. The installations were also adversely impacted due to the spread of COVID virus. However, the open access market has grown over the last 2 years with installations of 2.6 gigawatt and 3.2 gigawatt in FY22 and 23 respectively. This has been primarily driven by some favorable policies in some of the key states and improvement in the competitiveness of the renewable tariffs as against the grid tariffs in general. The latest wave of growth has been primarily supported by the conducive wind-solar hybrid policy in the state of Gujarat. Going forward, as per CARE ratings, the installations through the open access route are expected to witness an annual increment between 4 to 5 gigawatt over the next couple of years. And this would actually require debt financing to the tune of around 30,000 crore. Moving forward to the portfolio of some of the key developers and the improving tariff competitiveness. So as depicted through Exhibit 7, the RE C&I market is a fragmented market characterized by the presence of a host of players. Initially, on the developer side, the key players only included the C&I focused entities, whereas over the last few years, what we have observed is the leading utility scale players have also diversified their operations given the high return prospects and slowdown witnessed in the utility scale auctions in the past. The key demand side drivers for this market include, commitment of corporates to decarbonize their operations and supply chains driven by the ESG considerations. Additionally, the economic viability from a C&I procurer's point of view has also improved, and which has enhanced the appeal of this subsegment. On the other hand, the key supply side enablers include diversification of RE portfolio from the point of view of a utility scale developer and the adequate financing avenues that are available now. Moving on to the tariff trend that we have witnessed for the C&I projects in the country, the tariff applicable for the C&I projects is actually a function of three things: the cost of generation of green power, the open access charges applicable in a state, and the grid tariffs. So as reflected in Exhibit 8, for the CareEdge Ratings monitored solar assets portfolio of 1.3 gigawatt, the PPA tariff was actually above rupees 5 per unit till FY18, which has reached sub rupees 4 per unit level now. The tariffs have actually witnessed a decline over the past few years, driven by the decline in project cost and moderation in interest rates. Previously, C&I projects were fairly dependent on the state policies to offer them some necessary waivers so that they could become competitive. However, over the years, what we have seen is that these projects on their own have also become viable. Moving forward to the key open access rules that were notified by the government. So the government has introduced green energy open access rules in July last year to accelerate the transition towards the renewable energy and make the market more attractive for both the power producers as well as the consumers in the C&I sector. So some of the recommendations of the C&I rules are as following. They have actually recommended reducing the minimum load requirement from 1 megawatt earlier to 100 kilowatt. They have simplified the approval process by nominating a approval window of 15 days. On the banking front, a minimum banking period of 30 days has been stipulated. However, the credit for the banked energy would not be allowed to be carried forward to the next banking cycle. The DISCOM should also, allow banking of at least 30% of the consumer's monthly energy consumption that he's doing from the utility itself. Lastly, if we look at the green open access rules, they have also signified some of the finer modalities of the charges that are components of the open access. So they've capped the increment in cross subsidy surcharge at 50% for the first 12 years from COD. Secondly, if we also look at the additional surcharge would also not be applied in case a consumer is paying fixed charges. One of the other recommendations is that DISCOMs are mandated to have their own green tariffs, and its cost has been capped at APPC of the renewable energy plus 20% of the average cost of supply of that DISCOM plus a 25 paise margin. So what our view about these rules is, while the government aims to harmonize open access rules nationwide, individual states have the jurisdictional power to determine open access charges for their customers through their electricity commissions. Thus far, a few states such as Karnataka, MP, and Haryana have come up with a final order for adoption of green energy open access rules, and CARE Ratings has analyzed the same. While some of the suggestions primarily pertaining to reducing the minimum load requirement, applicability of a banking period have been accommodated, there are some things that remain untouched. What CARE Ratings notes that the existing green tariffs in most of the states, they continue to be a premium offering. That is, the customers have to pay a premium over and above the applicable slab rate from the DISCOMs. However, as per the recommendations of these open access rules, if the states were to calculate the green tariff as per the prescribed formula, it could lead to a reduction in the industrial and commercial grid tariffs and adversely impact the viability of C&I projects. However, in our opinion, the realistic possibility of these C&I grid tariffs declining and impacting the viability of these RE open access projects remains slim. Moving forward to the banking provisions that are there in the various states. So the exhibit on this slide indicates the prevailing banking norms in the key RE states. So states like Karnataka, MP, and Haryana, post adopting these new open access rules, have implemented a monthly banking cycle. The total banking charges in kind for as declared by these states is 8%. While the Forum of Regulators also suggested adjustment of off-peak banked energy against peak drawal by the consumer by providing some extra cost. Only Karnataka has offered such a solution to its customers. Both Haryana and MP have not permitted utilization of energy banked in the off-peak slots against the drawals in the peak slots. Among the other states, the key states of Tamil Nadu and Andhra Pradesh continue to not offer any banking to its C&I customers, which is a roadblock for the development of this segment. Although Gujarat does have a conducive banking policy for wind and hybrid plants, as no banking charges apply on them, Gujarat has very high banking charges of rupees 1.15 per unit for the solar units, which actually prohibits installation of solar plants through the open access route. Moving forward to the current waivers that are available in the various states. So currently the key open access waivers are available in the states of Chhattisgarh and UP. In Chhattisgarh, they are offering a 100% waiver on transmission and wheeling charges and cross subsidy surcharge for solar open access plants. In UP is also offering SOPs including a 100% exemption of electricity duty for 10 years and full exemption on additional surcharge. Given both these states do not have a very deep penetration of industrial customers, this policy can also act as a stepping stone to draw more corporate and industrial houses to establish presence in these states. The other key waivers worth mentioning include exemption of electricity duty for 25 years in Gujarat and exemption of electricity duty on captive projects for 10 years in Maharashtra. Moving forward, on the competitiveness of these open access projects, the landed cost per unit of a RE open access project comprises of two components: the base tariff as per the PPA with the generator and the open access charges, which comprise the following: the transmission charges, wheeling charges, cross subsidy charges, standby charges, additional surcharge, and banking charges. So CARE Ratings in its analysis has made an attempt to compare the landed cost from a wind solar hybrid open access project, both captive as well as the third party open access through the third party open access route against the prevailing grid tariffs for the industrial customers at a 33 kV voltage level. The PPA tariff for the wind solar hybrid project has been assumed at rupees 4 per unit. So if one goes through Exhibit 10, Owing to the exemption of CSS and AS, the group captive model is currently the most favored open access business model. The margin of safety, that is the discount the RE C&I project offers on grid tariff, ranges between 20 to 40% under the group captive mode, with the viability being the best in the states of Gujarat, Karnataka, and UP. However, as reflected in Exhibit 11, the third-party open access model, wherein all open access charges apply with almost no exemptions, it is currently unviable in most of the states. Only in the case of Gujarat do we see that the margin of safety is in double digits, and that is primarily on account of the high grid tariffs that are prevailing in the state. So coming on to the key risks that we perceive in the open access market. So there are various factors, which have been driving the renewable energy C&I market, and first of all, focusing on some of the drivers. So some of the drivers include that the credit risk profile of the ultimate consumers of power in this segment is much superior to, the DISCOMs, which are the off-takers in the utility scale projects. Furthermore, there is an increased commitment of corporates to decarbonize their operations and supply chains, which is primarily fueled by the ESG considerations. Additionally, the key open access waivers available in the various states enhance their appeal and incentivize consumers to switch to RE given the strong economic sense. The lenders' appetite also to fund these projects has improved over the years, and the interest rates applicable for the C&I projects have moderated over the last few years, thereby improving the viability of these projects. And lastly, if we see from a off-taker's perspective, they also have to comply with the RPO norms, and the RPO trajectory has been increasing year on year. So there is an additional requirement for incremental renewable energy from a off-taker's perspective as well. However, despite these drivers, the sector continues to face both regulatory as well as non-regulatory challenges. The primary regulatory challenge being there is a lack of uniform open access policies across states, thereby posing business growth related challenges. Some of the non-regulatory challenges include imposition of BCD on solar cells and modules, along with applicability of ALMM on the open access projects, which is expected to put some cost side pressure. Moreover, the increased competition on the developers front also poses a challenge on the returns for the projects. Moving on to our outlook and the ratings that are there in this sector. So CareEdge Ratings rates more than 3 gigawatt of the C&I projects at present. And in its rating distribution mix for C&I projects as on June 30th, 2023, what we see is that 58% of the entities are rated in the A category, and 42% of the entities are rated in the triple B category. So there are no entities that are presently in this space and rated in the sub-investment grade category. The key enablers for these ratings, they include the strong parentage, and which leads to actually a very healthy financial flexibility. Secondly, the counterparty credit risk profile is good. Thirdly, the strength of the PPA in terms of presence of a well-defined lock-in period plus termination payments and tariffs, etc., spelled out, leaving no gray areas. And lastly, the coverage indicators in most of the assets are pretty strong, as demonstrated by healthy DSCR and PLCR numbers. To put Care Ratings sectoral view in a nutshell, the presence of strong counterparties and their focus on decarbonization, plus the adequate resource availability as well as the strong investor interest, these are likely to be the enablers for the capacity growth in this segment in the near term. However, regulatory challenges along with non-regulatory factors such as imposition of BCD and ALMM, along with execution related bottlenecks, they would continue to pose as the key headwinds. So that's all from the presentation point of view. Thanks for being patient, listeners. I'll hand it over to Mangesh.
Thank you, Jatin. Now may I invite Rajashree Murkute to take over this session, please. Rajashree is a Senior Director and heads the infrastructure vertical at CareEdge Ratings. She has 20 years of industry experience, specializing in corporate credit rating with a focus on the infrastructure sector. At CareEdge Ratings, she has led various rating teams across diverse sectors within infrastructure and corporate verticals. Over to you.
Thank you, Mangesh, for the quick introduction, and Jatin for the wonderful deck presentation. Good evening and a very warm welcome to one and all who've joined us for today's webinar on Indian renewable energy sector with a special focus on C&I segment. We have today with us undoubtedly some of the best minds from the industry to deliberate on the subject and share their valuable perspectives with us. I would like to introduce you to our esteemed panelists in alphabetical order. Our first panelist is Mr. Mitheel Mody from Tata Cleantech Capital Limited. He's a senior infrastructure and cleantech finance leader with more than 2 decades experience in project and corporate finance, having worked across various financial institutions, investment banking and corporates. At Tata Cleantech, Mitheel heads the business origination, coverage and relationship function, managing a book of more than rupees 11,000 crore. He was also instrumental in setting up the debt distribution and other infra verticals at TCCL in his previous roles. Mitheel is a chartered accountant from ICAI, MBA and law graduate. Welcome, Mitheel. Our next panelist is Mr. Nikunj Ghodawat from CleanMax Group. Nikunj holds 18 plus years of experience in corporate finance, fundraising, and building team and businesses from early stage. As Group CFO of CleanMax, he has led fundraising and various strategic finance initiatives of the company, played instrumental role in building the team, as well as raising over $1 billion for the business from multiple avenues. Nikunj is a PGDBA and holds an MS Finance degree. In 2017, Nikunj was conferred as the Best CFO of the Year award by Solar Quarter. Welcome, Nikunj. Our third panelist for today's session is Mr. Nisheeth Khare from Aseem Infrastructure Finance. Nisheeth is a civil engineer and an MBA from JBMIMS, Mumbai. He has an experience of 18 years in the areas of infra project finance, corporate and structured finance, and as well as construction of projects. Prior to joining Aseem Infra Finance, Nisheeth has worked with Continuum Green Energy, L&T Financial Services, Yes Bank, ICICI Bank, and Tata Housing. In his previous role, Nisheeth led the corporate finance function and managed an infra project finance asset book of close to 20,000 crores. Welcome, Nisheeth, to our webinar.
Thank you.
And now let me introduce you to our fourth esteemed panelist, CFO of O2 Power Private Limited, Mr. Shyam Sharma. With a rich industry experience of 25 years, Shyam has led senior management teams of various premium energy giants, namely Sembcorp, Azure Power, before joining O2 in 2020. He was instrumental in building a balanced gigawatt portfolio across utility scale government off-takers and distributed generation, that is both C&I and rooftop. Shyam is a qualified chartered accountant, company secretary, and cost and management accountant. Welcome, Shyam. Now, for a few preliminary remarks on today's theme. So the Indian renewable energy sector is anyways constantly going through an extremely dynamic phase with large opportunities to scale up, necessitating major investments to build or either upgrade the existing infrastructure. We are witnessing the governing authorities as well as private participants closely work together over years to achieve this goal. Yet the challenges in the form of supply chain disruptions, regulatory uncertainties, volatile PLFs, technological advancements, etc., they all persist and pose as roadblocks. If we speak about renewable energy open access market in particular, the theme of our webinar today, it's growing in almost all key renewable rich states. And nearly 2/3 of the current 13.6 gigawatt renewable energy open access capacity, it has actually come online only in the last 5 years. So indeed, increasing awareness and demand from C&I customers was a key growth enabler, apart from policy-led push in the recent years. Yet the pertinent question is, will this be the new growth engine for the renewable sector, accelerate the nation's clean energy transition, and what are the perspectives of the industry and finances? These were some of the questions that we had in mind when we decided to hold this webinar and get our industry experts deliberate on these ponderables. Well, let me not impose further on the answers to these questions, and I'm sure we'll have the experts tell us how they think the situation will unfold. So my first question is to you, Nikunj. From the standpoint of C&I sector evolution, if you see from close to around 300 megawatts in 2009, the market size of renewable energy open access has grown to 13.6 gigawatts by the fiscal year 2023. And 2/3 of it in any ways has come in the last 5 years. So in your opinion, what is a key sector enabler which has proved to be a game changer or kind of hasten this evolution?
Sure. Thank you, Rajashree. And maybe let me take a step back on this and see it from the perspective of that when we say C&I, right? C&I as a market is primarily corporate and industrial demand of the country, which represent 50% of the overall demand of the power sector in the country, right? And one is that looking at from the renewable gigawatt perspective, but other is that what is the penetration we are talking about, which corporate going from brown power consumption from grid to the green power. So we are still talking about a fraction of a percent, a couple of percentage of the overall demand of the corporate is going green, right? And before I answer the question, I just want to take a macro view on that. It's always good to see the things in perspective, which is more macro versus just looking at what megawatt, what gigawatt next year. And my belief, and also the belief of all at CleanMax, and that's also our sustainability. That's also our mission, is to be sustainability partner for private user. This all comes from a belief which we have that transition from brown to green is a big mega trend which we all will see in our lifetime. The world, the energy mix which we see today, right? And I'm not saying just about the power as an energy mix, it's the overall energy mix and the sustainability as a sector. There will be a big mega trend which all of us will see in our lifetime today. The way we travel, the EV is one aspect, then power is another aspect on which this entire discussion is going to change. And if that has to change, like various other sector where we see the big transition, that would be led by the consumers, right? And not by the government. Government will play an important role in terms of enabling the sector, creating the conducive environment. And once that happens, there is a J-curves happen in any industry you see, whether it is transition in let's say internet, right? It has become part of our life now. But there was a time in 80s, 90s when it was early stage. But now it's part of our life. We live it, right? But that transition is led by the end user and the corporates, not by the government. If you take transition in automobile sector, similar thing you will notice. Transition in telecom, similar thing you will notice. So if transition has to happen, the world has to go green, and India has to become green, right? That transition would not led by the government, but it would be led by the end user, right? And given the way the sector dynamics are in India, regulation-wise and other factors, if you consider all that in, and if that transition has to be led by the private sector, the first segment within that sector is the corporate and industrial customer who has to take the lead, right? So one is this overall transition, it has to be led by them, and it is the need of hour now. Right? I'm not going into the climate change and other things where the time is running short and the various changes we are seeing. So that's one thing. Second, which is another very important thing, right, which we need to notice or we need to be aware of, is the why corporates are doing that, right? One is, we all just saw a slide that there is a 20 to 40% saving, this, that. But that's not the only reason for which the end users, which I would say is the first category, is corporate, but eventually most of us will go green in our lifetime, right? They are doing it because it's ticket to do business for us now. It's not just one of the cost saving measures, right? And I can take many examples, but you take any industry, right? For example, any manufacturing company, right? Their entire supply chain and their end consumers, right, need the sustainability check before they procure from them. So this is coming from the global supply chain. The Fortune 500 companies, that's coming from them, right? If you are a manufacturer of an auto component company today, and if you want to supply it to Mercedes-Benz or BMW, you need to, at a particular point in time, have to procure green power. So it's becoming part of the ecosystem. So it's no longer cost saving, and that's driving the big change. So one is that at a macro level, if it has to happen, which we firmly believe will happen, energy mix will change, then it would be led by government, corporate, end user, not by government. And second, it's ticket to do business now. It's no longer just good to have thing. It's a very important thing to have to do business. So these are, I would say, two macro reasons. Other than that, some points already touched upon by Jatin, that in the process you save cost, there are other benefits, blah, blah, blah. But just looking at the time, I'll just stop here. but I hope I made my point.
Sure. So the big messages that you have kind of put through is largely in terms of, the demand pull which is coming from the consumers, which typically again will have to be driven by the corporates, and it's going to be a method of an ecosystem, and that's how it's going to be. It has to be gradually the way of life for across all of the sectors. I mean, and we cannot really remain untouched with this whole phenomenon, and therefore that's where the policy also framework starts enabling. Any different views or anything that you wish to add, Shyam, on this?
Oh, I agree with Nikunj. He has presented it beautifully. So all the key levers are there, which will further enhance the overall growth in the C&I segment. So basically, the industry will start moving from utility to C&I side. So which has already started. The transition has already started.
So Rajashree, while Nikunj and Shyam has covered, I had 2-3 more aspects to cover on this. So 4 factors have happened, in the past. One is the commercial aspect of the sector itself. C&I is a win-win for a developer and for the consumer. True. That is the primary drive. It is not, relying on any subsidy. It's not relying on any support. It is by nature itself viable and attractive. This coupled with the fact that when any consumer is opting for a C&I power source, they're also meeting their own ESG obligations is like icing on the cake.
Absolutely.
So this is one factor. Second is also about the government encouragement which has come in this sector. If you look over past 3 to 5 years, almost every quarter or at least in a semi-annual period, there have been policies which came out at a central level, at state levels, which have encouraged development of C&I. So you will see ISTS framework, you will see waivers which are applicable to a certain time period. There are various things which are. The third factor, which is, I would say, very important for the kind of sponsors who are here today and the kind of off-takers which are entering the sector, is the corporate governance part. You will observe that today C&I, when it is pitched by a developer to an off-taker or when it is being looked by a financier, it stands very high on the corporate governance scale. People are not trying to, do something for the only profit part of it. They have an objective of commercial nature. They also have an ESG objective. And while doing the entire business, corporate governance is kept at a very high level. So these are the 3 primary drivers which are pushing. Now, what has it done? You will observe that the kind of sponsor profile, how it has changed over the last 10 years. Today, almost all developers are backed by large players, and these are of highest repute. Even in the panel today, you have someone backed by Brookfield, someone backed by Temasek. Look at these names. When you talk about off-takers, you will find AAA category of off-takers ready to, procure power from, developers like Nikunj and Shyam. Similarly, when you look at the lenders profile, which has evolved over a period, you will see how this industry has kept, lenders warmed up towards it. You go back 5 years, it was a different landscape. But today, everyone is looking at it very favorably. So I just wanted to add this part that it's not only the demand, but it is an ecosystem which has evolved, which is helping and pushing the sector.
Yeah, I agree with you, Nisheeth, and thanks for bringing in that perspective. In fact, with the opening remarks, which has come so positive from the developers, I also wanted to take a dig from the lenders. So, Mitheel, I would want to hear from you. So, as a lender, do you now believe that the R&E C&I sector per se, these risks have been well understood, and there is enough appetite now for project financing in these projects, especially in India? Because as per our estimate, which we also flashed on the deck presentation, the debt financing requirement, which we believe in the next 2 years should be close to about 30,000 crore. So do you think, are there any open risks which are still there and keeping the lenders cautious from this segment?
Sure, Rajashree. Thanks. So I think good presentation by Jatin, and thanks to you and Nikunj and Shyam and Nisheeth. I think you made the points. So this sector has gone through a evolution. I think in the last 5 years it has just exploded in a way. And at Tata Cleantech, actually, we were in that sense one of the early movers in this sector. We sort of started financing C&I maybe 5-6 years back. And at that time, it was, a little lonely because we were probably, one of the only ones or one of the few ones who were there actually financing this sector. And I think, our belief as to why the economic rationale and the crux why this sector should explode has sort of stood out because of 2-3 key reasons. That one, the whole ESG becoming more of a business necessity. Second, the cost economics itself panning out, where there is a very clear economic rationale and not just a only ESG rationale, which is why the sector has exploded. However, coming to your specific question, are there any policy risks, either open risks? So the answer is obviously there are open risks. You cannot completely close your eyes, but so I'm saying one, that the lenders have warmed up. A lot of lenders have warmed up. I think as Nisheeth also rightly pointed out, it's also a function of a lot of credible players having come in place, the support of the regulatory framework having been in place. So that is been some of the key drivers apart from the economic rationale, which is probably the main driver. And therefore, given that how the track record has panned out over the 3-4 years, the lenders have, I think, expanded. So earlier, if there were 2 or 3 players financing this sector, there are at least 10 players, I would say, now there. So and which is required because the size of the market has also become maybe 30 times of what it used to be 5 years back. So obviously, you can't have 1 or 2 or 3 lenders, otherwise the sector can never export. Having said that, there are risks, and I think the single biggest risk to my mind in this sector is the policy risk. Because a lot of positives going for this as a sector, but the policy changes or the sheer change in regulatory regime is something which is reasonably unique to this part of the sector versus the larger part of the sector. With respect, we've seen how things have panned out. We've seen how Haryana, for example, was one state where there was a change in the policy, and a lot of developers have gone through that. Or we've seen how banking regulations have changed, because at the end of the day, discoms are losing in some form or the other their higher, the priced customers, if I may put it. So there is a policy, this thing. But having said that, I think the legal framework and the regulatory framework has also stabilized. So I think as long as the developers are going by the book, following the process, I don't see a challenge where you should be challenged. But if you don't go by the book, if you sort of try to take certain policy shortcuts, for want of a better word, if I put it, that is where you expose yourself to a large part of the risks. So the single biggest risk, in my opinion, is the policy risk. The other risk, I would say, are common, which whether it is with BCD, whether it is with the model prices, the evacuation, the land. So that is something which is common. And I think now, as a sector, as lenders and as developers, all of us have understood how to sort of mitigate to some extent this risk. So the single biggest risk, as I said, is a policy risk, which is something we have to keep at the back of our mind.
And I think, it kind of echoes with some of the constraining factors with which we also put up. A lot of things, the ESG considerations are definitely something which are driving in favor of the sector. But yes, the entire disparity which we are seeing across states in terms of the policy framework, their implementation, that is one roadblock for sure. Mr. Shyam, I would like to come to you to understand, on the same aspect. Now, as a developer, when you look at exploring different states, according to you, how do you, evaluate this in terms of which are the key states that you think are offering significant value to set up future projects? Because as I said, there is a disparity when it comes to the policy framework across states. So can you shed some light on what are the differentiating factors which are supporting growth in these states?
Yeah, sure. We can divide into intrastate and interstate projects. So in case of intrastate projects, states like Maharashtra and Tamil Nadu are predominantly there, while Odisha, because of their new policy, has also become now favorable. So Karnataka, I would say that they were the leader earlier, but now because of so much saturation happening there, they are not offering that kind of value right now, valuation. So the key differentiating factors which we evaluate while entering into any new state is how favorable the banking provisions are, what is the gap of demand and supply there, what is the overall landed cost to the customer and the saving we can offer to them, and overall the stability of the policy regime. That is very important, as already highlighted by Mitheel. Because states like Haryana and sometimes UP also, so they have done a lot of to and fro. So that's why all the developers would like to enter into state which have a stable policies. and overall how industrial that state is. So that is a major factor where the growth will come through. In case of interstate solution, we can get through all these problems and we can offer much better solution to the customers in form of round the clock or hybrid projects, where we can co-locate projects in higher generation wind generating states or higher solar generating states. We have seen some large deal closure like Amazon, Cefi, Jindal Steel, which has closed, and or Vedanta or ArcelorMittal also. And the market is very fast evolving in the ISTS sector at this point of time, and very large quantity of the power requirements are being auctioned right now. So we are right now running through a proper RFQ and online auction process for these large scale projects. And the main differentiating factor for growth is because of the waiver of the ISTS charges, higher CUF being offered, and overall ESG sustainability targets, which we have already spoken around by the other esteemed co-panelists. So these are the views from O2 Power's side.
Sure, that speaks, how well and how cautious the entire approach would be when you are planning to venture into any new state. Because in any case, the top few states are kind of ventured by many of the developers already, and one would have, the entire advantage of seeing how the behavior of the state has been in terms of policy implementation. But yes, the new states will have to wait and watch and figure out. My next question is to you, Nikunj. In terms of, if you notice so far, majority of the development that has happened in the C&I space, that's through small and medium-sized projects, and mostly again located within the same state. So do you see the C&I projects, especially connected to the ISTS network, which Shyam just touched upon, that they will be gaining more traction in the near to medium term? You're on mute.
Yeah, see, in C&I, there are thus far even the within state projects which we talk about. I think we have seen large scale park also, because we have 2-3 very large scale, mega utility scale park which are servicing the customer. So it's not only the small size park which has been servicing the C&I demand. It's just that the end customer within that park may have a small capacity. So C&I thus far has not been just purely through the small scale size project, but it has its utility size as well. And between ISTS and non-ISTS market, I would say there is a market for both. And why I would say there is a market for both, because ISTS has its own complication, right? Because it comes with certain specific scheduling requirements, right? So it can be suitable for a specific set of customer, but not all set of customers, right? Because you have to have 15-minute interval scheduling and other things one has to look into, right? So and there are some states where it may make sense to do ISTS only, right? Because for you to go and set up a project in those states may not be viable. Both types of project you want to do, wind and solar both, right? Or provide a hybrid solution, then ISTS may be a better solution in those states, because wind is a very state specific phenomenon, right? So considering all factors, right, it's not that there is one solution which fits all clients. And that's where the C&I market start getting differentiated from a plain vanilla utility market, whereas there is a project, there is an auction, and at the end it becomes some execution skills, but it's more of a capital allocation and how good you in terms of capital allocation, and there that's what defines who the winner is. But in C&I market, I would say it's not winner takes all market, and it's not one product solves every need, right? So these are the two things which are very differentiated in C&I market, and that is why, right, there would be few customers which are more suitable for ISTS, because they have a base load demand, you can combine it with multiple things. The state in which they are, maybe the ISTS is a better solution, but there are states where you can put the project within the state and also have the demand within the state and have the diversified pool of customer there may be a solution which is non-IST, right? Because there are benefits like banking, which ISTS may not offer, or at least there is no clarity. So there's no straight answer. It is consumer by consumer, then what solution fits to which consumer. And that's where the C&I becomes very differentiated offering versus setting up megawatt or gigawatt. It's purely consumer driven, and what solution fits to a consumer can be very different for when you just walk into the next factory.
Indeed. So it has to be a pretty much draw a unique risk return matrix for each and every deal that you work through, each transaction, each state, and then come out.
My answer to that, there'll be a market for both. IST is a very positive development because it enables or it opens up a market which thus far was not there.
Yeah.
Right? And it addresses that problem of multiple state charges. So it's a very good development, but at the same time, there'll be a market for both type of operation.
Yeah, and in any case, because the sector has just started its green shoots, pun intended, it's quite, there is a huge availability of demand and scope and market penetration across all the segments. So, well said. I would take views of yours, Nisheeth, at this point. Basically, I want to understand more on the competitive intensity, which is rising. As we said 5 years ago, as Mitheel said, 5 years ago, the number of players were hardly any, and now you're actually seeing a lot of developers evincing interest in this. So earlier, if you see, the PPAs used to be primarily with either MNCs and higher rated, say AA and above rated kind of entities. Now we are increasingly seeing inclination of these developers towards signing PPAs with either moderate or some lower rated entities. So as a lender, do you think this increase in competition is marginalizing the coverage matrices of the players?
Yeah, thanks. So I will just put some context to this, this point that you have raised. The C&I market today, accounts for approximately 30 to 35% of the country's total electricity requirement. And within this, the open access penetration for C&I segment is less than 10%. Considering the fact that electricity is a fundamental necessity for the operation of any plant or office, this presents a significant, I would say, untapped market which is available. As we discussed earlier, the commercial attractiveness of corporate PPAs for both off-taker as well as consumer further reinforces the potential for a rapid market penetration in coming few years. As PPAs move from being signed with a AA or a AAA category off-takers towards a category and investment grade off-takers, the risk-related parameters are carefully managed through, I would say, robust PPA conditions, which will span across the tenure of the contract, the kind of lock-ins that are being agreed upon, break penalties which are contracted, the tariff itself which is contracted between the developer and off-taker, payment security mechanisms. How do you pass on the open access charges? How much is taken by the consumer, how much is absorbed by the developer, the PLFs which are committed, and any penalties in case of any delay of executing the project. So that is captured. And from the lender side also, lending structures will also accommodate, will reflect the assumptions for, financial projections. Appropriate calibrations will be done for debt sizing, and stipulation of maybe enhanced reserve requirements will be there amongst other measures to handle this risk. An essential aspect, that I would say worth highlighting here is the repeat business, which is generated by leading C&I developers with their existing consumers. What we understand is remarkably, they account for around 55 to 70% across leading developers in the C&I space. This not only demonstrates that high customer satisfaction is there with the developer services, but on the risk side also showcases the ability or the capability of developer to replace the off-taker if such need arises.
So yeah, repeat business, definitely, you have a said off-taker and a said developer. You already assessed the risks and everything is kind of understood well. When we're looking at the increased competitive intensity with newer players coming through, what I hear from you is largely you'll try to take care from the structuring point of view and try to create more ring fencing, more robust reserves, and add for more buffers such that overall that kind of is addressed. even if you see that the counterparty is not so great, at least from the lender's point of view, you have guarded your position.
It will get addressed both from lending structure as well as the
PPA structure.
PPAs will reflect the off-taker credit rating, or the quality of the off-taker.
Sure. Shyam, on the same, connecting question on this competitive intensity. Now, again, from the developer side, given the entry of new players, as well as there are existing utility scale players also who are now diversifying in this space. So do you see this increased competition is now kind of impacting the returns of the developers?
Yeah, so the C&I market was quite small 5 years back, and only few C&I focused players were doing it. But as the market is evolving, new regulations coming in, all the utility players also have now diversified into C&I side of it. So we have observed in last 2-3 years higher competitive intensity, and that obviously is resulting into the lower tariffs for the customers, where their customer rating is quite high, their capacities are good. So there it is competitively fought between the 4-5 major players. So given that background, but still customer give a lot of emphasis on the capability of the developer who can execute the project on ground. It's not what Nikunj is also have stated. It's not that the L1 wins every business. It is also about how much capitalized you are as a developer, how much execution capability you have as an IPP, what kind of capital commitments you have for future development, overall how much land bank or connectivity you have. So overall, and plus because these are generally listed companies, the board places a lot of emphasis on the pedigree of the promoters or the sponsors behind that platform. So that is major differentiating factor, because as a part of corporate governance, their name is also at stake. So they cannot do SHA or PPA with any small developer. So that is a factor there. So overall, if you have a strong pedigree, strong execution skill set, have lot of connectivity and land availability with you, and track record, there obviously you can protect your margins. And even this is market for everyone, so you will find buyers at every price point, in my view.
Sure. So basically what you're saying is there isn't major threat to developers who have good financial flexibility, either through a strong capital access, or at the same time who have also demonstrated good execution capability. So obviously their competitive edge doesn't really diminish. That's
why the repeat business percentage is quite high. If relationship has started with a corporate, we typically don't want to work with other developers.
Right. We shall be actually taking questions from the audience in a short while. So I'll request the participants to key in their questions in the panel. And while the questions come in, I have a few more questions to our esteemed panelists. My next question is to you, Mitheel, on the financing mechanism and the structures. So far, we've not seen many co-obligor or pooling structures in the C&I projects, whereas they've become pretty common now for the utility scale projects. So do you see any specific deterrence or say partial ownership, especially in the captive projects, for upstreaming of these cash flows of such structures?
Yeah, so you're right. So while we've not, I'll just give a little perspective. So while we've not seen a lot of co-obligor structures for obvious reasons, that obviously these are ownership of the respective SPVs are diversified. But we have actually seen a lot of cash pooling structures. In fact, we ourselves have funded many of them, where we have done a cash pooling. Now, this is also subject to the fact that what is the actual nature of the arrangement that the developer has with the off-taker with respect to sharing of certain profits or sharing. So I think while it also becomes a function of that, but with wherever we have done projects, we've actually done a few cash pooling structures, cash Co-obligor, obviously, for obvious reasons, is not possible or is very, very difficult. And anyway, now I think with the way the structure is moving, it is effectively moving to a one SPV, one off-taker kind of structure with the new rules anyway likely to be in place. So with that, in fact, it will get even more difficult or probably impossible to do co-obligor structures. But to my mind, cash pooling is something, as long as there is adequate I would say transparency built in from a developer to the off-taker and also the investor. I think cash pooling is very much possible, and we've ourselves funded a few of those.
And you believe that's going to kind of catch up pretty strongly because
in fact, I think that would become the trend more and more going forward, because see, again, as I think Shyam also mentioned, the market can be broken up into two parts. One is the typical ISTS, which are the larger projects that are there. And the second is the single location but then across multiple off-taker kind of structures. So in the first one, obviously, those are larger projects and those will get funded in that manner. But in the second category of projects, where you have multiple off-takers, but sitting across in the same park, where actually evacuation is shared and where other things are shared, it actually makes sense to fund them as a bunch rather than fund that in a disaggregated basis. So that way, I would say with at least in this particular piece, the cash pooling should sort of increase going forward. Is what my belief is. And as I said, there are structures which we have funded, and some of the developers are getting funded in these manners.
Great. That's really encouraging in terms of the new mechanisms and rather more pertinent mechanisms which will prevail in some time. Nisheeth, let me understand from you on the evaluation approach on the strength of PPAs. Say, given the corporate PPAs which are not standardized unlike central PPAs, as a financer, what according to you are the key clauses that are a must-have, kind of, in your opinion, for these documents to be considered bankable?
Certainly, thank you. So I will come to the key clauses which are required from a lender's point of view for them to be bankable. But before we go there, just trying to bring out the point again that corporate PPAs are entered because they are compelling commercial advantages for both the developer and consumer, and they also fulfill their ESG objectives. For developers, it means that they have a higher net tariff compared to the opportunities which they get from a central or state PPA. And conversely, for off-takers, it means that gross lower tariff compared to what they can source from an alternative source, such as state discom. Now, why will a PPA get terminated? A PPA can get terminated primarily because of two aspects. One is from the developer side, second is on the consumer. The inability of developer in supplying city from an operational project, if it happens, of course, then there could be a force majeure situation and it could lead to termination. When we talk about the consumer side, the reasons for termination may include the maybe availability of alternate power at lower rates, or maybe at same rates but higher PLFs within the contracted capacity, which will want them to actually push them to move out, or maybe financial deterioration leading to the shutdown of the plant which is using that power. Given this context, the key clauses that any lender would look in a C&I PPA will cover aspects like what is the payment security mechanism, which is kept so that the payments obligations are met reliably. Then at the break penalty, outlining the consequences of early termination by either party. It will also look at the lock-in periods, indicating the minimum period during which the contract cannot be terminated. Then the tariff itself, which is contracted, ensuring it remains attractive for both the developer and the off-taker. We discussed earlier the pass-on of open access charges for any variations, whether it is contracted, providing clarity on how such charges will be handled. Then committed PLF percentages, defining the guaranteed minimum PLF for the project. And also the penalties for any delays in case the project execution is delayed. As Shyam mentioned, it is very important from a consumer point of view that projects are delivered on time. And then resolution for delays.
I observe that the aspects that you have touched upon, be it from the payment security mechanism or the termination clauses, the lock-in periods, and so on. By and large, all of these were the reasons also why, which have led to a fair bit of a strong ratings or the rating profile. If you look at the rating distribution slide that was presented, some of the factors that we said, which have supported the ratings as such were prominently around the same area. So I think we echo on the same lines. Let me just come to Shyam. My next question is to you here. despite the resolution of the long-standing jurisdictional dispute that we've seen in October 2021, especially. Now, the virtual PPAs, they have not quite hit the ground, despite their promise. So what, according to you, are the key factors which are restricting their growth at the moment?
So, although the apex court has ruled that the electricity will now be treated as other commodities with forward contracts and derivatives on exchange, there is still a lot of apprehension, the end user as well as the developers, because there are no clear-cut guidelines and in whose jurisdiction this will come, either SEBI or MOP. So that is the major factor which is constraining this growth. Otherwise, there are a lot of MNCs which are looking for virtual PPAs, but till the time these regulations are clearly spelled out and whose jurisdiction it will come under, I don't think before that anybody will take a risk on that.
Yeah, so prima facie, yes, the policy and the regulatory framework being, while the announcement is already done, we yet to see how it will unfold. In fact, some of the market sources, they have claimed that the VPPA market might contribute close to, say, about 14% to the national RE target of 500 gigawatt capacity by 2030. Now, if that needs to be achieved, then obviously a lot of other hurdles and the ifs and buts have to be put to rest.
Additionally, how lenders will look at it while financing, that is also something which needs to be, or which will evolve, I would say, because lender would see a lot of risk in this.
Sure, sure.
So might be Mitheel or Nisheeth would be able to
yes, sure. If
advise on the lender's concern on if we bring any VPA to them for funding.
My last question is to you, Nikunj. I started with you in terms of the session as well. As per the electricity amendment rules from April 2024, now the states have to mandatorily offer at least a 20% discount to the industrial consumers, especially during the solar hours. Now, could this decline in the grid tariffs during the solar hours serve as a roadblock for the growth of the RE C&I customers subsegment, as customers may offtake the entire power directly from the discoms? What is your view on this?
So I would rather take a contrary view that it would bring uniformity, because even today, the price, there is a different pricing for the peak and non-peak, right? And the difference in some state is even more than 25%. Most of the solar is generated during non-peak hours, right? The peak of solar is during non-peak hours only. And the tariffs are already at 25% discount to the peak in many states. So if you see the facts of the thing, there is already a discount or differentiated pricing for the peak and non-peak.
Okay.
Not that that doesn't exist, right? And majority of solar is not generated during peak, right? Rather, it would bring a uniformity that difference will only be 20%. Right. And second thing, which is need to be noted here, is that what current savings which are available, right? Off-takers are not just looking for solar as a solution, but they are looking at their overall penetration of green power and the saving against it, right? So individual solar anyway today offers much lower than what 20% discount to the grid, because the delta in most of the state is much higher than that. So, and second thing is that if you see it on an overall solution perspective, no off-taker or the big off-taker just looking for solar as one solution. They are seeing a comprehensive solution of what percentage of RE power they are procuring from a variety of things from a particular developer with whom they are procuring. So if you see things in combination of everything, I think this particular regulation rather bring a uniformity that the difference between charges would be 20%, which is a good. I don't see that as a big deterrent as far as the procurement of green power from the corporate perspective. And this differentiation in price already exists. It's not that it is not there today.
Got it. So yeah, in that case, it So expected to bring in more uniformities is what you are conveying. Great, that's an interesting perspective. So with this, we come to the end of the panel discussion, but we shall now take the questions from the audience. Our first question has come from Ms. Indukalpa Saikia. The question is to Nisheeth and both Mitheel. How will lenders such as Aseem and TCCL will look at RE-RTC projects, considering that these plants will have some excess power, which will be sold in the open market, that is oversized RE capacity to provide RE on RTC basis? Do you want me to repeat the question or?
No, I got it.
Okay. So, Mitheel, you are taking it first?
Sure, I can take that.
Okay.
So, no, this is something which is interesting, and to be honest, developers have sort of sounded us out on this, at various points of time. So obviously there is no clear or direct answer, but the answer is that obviously it depends on how you are sizing the RTC projects in the first place itself, and what quantum of the excess power is likely to be merchant, and what kind of portion. That is number one. I think the answer to that is, as a lender, or at least that's the way we look at it, is that we can always structure our solution around this. So it is eventually a function of how you size your debt, how you size some of the covenants across these kind of projects. So these kind of projects can be looked at. There is no doubt about that. It is just that how you size some of these projects, how you structure some of these projects is becomes very important and critical when you finance these projects. So the answer lies in that.
Yeah, so I agree with Mitheel. When you look at projects from RTC capacity, which also has a merchant component, it will depend on what kind of assumptions are taken into play on a long-term basis for the merchant tariffs. Today, you might enjoy a higher tariff, which can go further high or may go down over the period of time. But a right assumption, or maybe assumption basis that demand supply in that particular geography, if it is taken, that mitigates part of the risk, which leads to debt sizing. Another thing which can be done for this is if the lender perceives that today tariffs are high, and there could be a cash sweep which can be done, so that over a period of 2, 3, 4 years, my debt becomes to such level that even if tariffs were to go to say a lower level, then it still remains viable. This can still be a win-win for both, lender as well as developer, because they still can enjoy the higher royalties because of the merchant component. And maybe after 5 years, if the tariff scenario is changed, they can take a top up on that. And from a lender's point of view, the risk is mitigated.
Great. I think that answers the question. My next question is for Shyam. This has come specifically. It says, what's your take on the ISTS projects for RE, particularly providing RE power on RTC basis, and how this will change the C&I market going forward?
So we as an organization are quite bullish on ISTS projects, and we are almost doing projects of 500 megawatt in this segment. We feel that this market will grow, subject to the timeline extension on the waivers. But right now it is still 25 only. So if that is extended, then this market again will explode. And all the developers are planning around it. So this is the market to be in if you are in C&I.
I have this next question from Ramakant Kandula. I'll request Nikunj if you can take this. What he wants to understand is if this is the right time to do a refinance, or it is the right time to sell or buy new C&I projects, more from the inorganic growth perspective, given the interest rates are at peak compared to pre-COVID levels.
See, in a running business, you try and not time it, right? You always try to match and look at it more classical project finance way, because you are doing it consistently, right? So over a life of the asset, you always hit the average interest rate cycle. And you have to, because as a business, you are doing it every day, right? So I won't answer it more from timing perspective, because we are not in a business of timing the interest rate. We are in the business of providing solutions to corporate, and as part of that, financing is one of the things we have to do, and we have to do what is the right financing solution at that point in time.
Ultimately, it has to make return sense and economic sense to take the decision.
So if there is an opportunity to service a customer today, you have to take the interest rate called what interest rate scenario exists today and accordingly place your cash flows and the risk profile for that project at that point in time versus taking futuristic view on interest rate. You can take a little bit of long-term interest rate call, but can't really exactly try to time it because I believe that strategy over a long term doesn't work. You have to always place it in a particular environment and solve for that situation. That's my answer to that.
Sure. To each his own. Basically, every developer will have, again, their own methods of maximizing and optimizing the return. So timing is unique to each of them.
So just to add to it, it is not only the financial return, it is also adding into a customer which you can service it in other locations also. So that.
As just to add, and as the cost of capital is one of the important factor in this business, you'll continuously try to optimize it. Right? So from that perspective, this is not one can ignore, but that's not the key decision making criteria when you're solving for a business situation. That's an important criteria.
Okay. This is one particular question which has come from Mr. Jay Batija. He's saying, what kind of annual growth in C&I space can we see going forward since the land is not limited? Rather, land is not unlimited. Also, with so much equity available, wouldn't deployment be an issue? So we're seeing a lot of, anyways, capital funds associating with this entire segment. So I think it's more to do with that. So Nikunj or Shyam, any of you would like to take this?
So I can try and Shyam can.
Okay, sure.
So see, the physical infrastructure is limited. I don't disagree with it. And even in some of the developed market, it is one of the constraints, right? In India currently, if you compare it some of the European or other developed market, where the development cycle itself is 2 to 3 years, right? For start to project to take it to the construction stage, right? Whether even a normal village NOC is also a process versus the Gram Panchayat NOC here is a much simpler thing. So from that perspective, India currently is still it's relatively easy in terms of the timeline, but India has India-specific constraints and challenges. But yeah, physical infrastructure is limited, but I don't say that currently it is a serious problem. There is enough opportunities where you can go develop project, find right substations, right connecting point, and even government is working on the transmission line infrastructure and trying to see that which are the areas where the more capacities can come, right? But can that be a limiting factor? At some point in time, it may be, but right now I don't see that as a challenge. But it's a right thing that physical infrastructure is finite; it's not infinite, right? And as more and more capacities come up, not only the physical infrastructure, there is going to be a grid level balancing and synchronization, because all RE is not a firm power. Those things has to be dealt with. But we've seen even developed countries have also seen it where even on a solar day, in Germany, you have some shutdown of the thermal power plant, but there are ways to deal with it. But that's not a problem which we need to be too worried about today. And I think the way the infrastructure is being planned by the government, I think all this factor is being considered as the overall planning. And what was the second part of the question? The equity in the segment.
Yeah.
I would say this is a good problem to have, right? Because at one hand, we just saying that it's just few percentage of the overall corporate demand in million units term has been moved from green to brown to green, right? And if a significant percentage has to go to green, and most of the top 500 companies have a 100% green penetration target in a finite period, which is next 5 to 8 years, right? I think the quantum of capital and quality of capital needed is much bigger, much higher than what we currently have, right? And though the capital is available, but that's also important things to notice is that there are players who are also struggling to raise capital. So the capital also
fine balance.
Yeah, because the nature of capital is not that it's available to all. It's available to the people who are deploying it right.
True.
Right. And I don't want to name, but even in last 6-7 months, we've seen that there are companies who struggle to raise capital. There are players who have had multiple options to raise capital, right?
Absolutely.
So that's another factor. But I believe that today the requirement on both debt side and equity side, if we see at a little longer perspective of the sector, is much bigger than what is available. But good news is that the India has created an ecosystem right from capital market to debt market to the banking system. It's created a conducive environment which will continue to attract capital. So as and when it is required, capital should come into this sector.
Yeah, we have the right demand drivers, and supply side from the finance side also is not really an issue by and large, more so with the ESG consideration. So I think yes, deployment shouldn't be seen as a challenge per se of the equity. Well, this is an exciting topic, but I think due to paucity of time, we are unable to take up all the questions. Apologies to the audience. But thank you again to all our esteemed guest speakers for their insightful views and patiently answering all the audience queries to the extent possible that were posed. Nikunj, Nisheeth, Shyam, and Mitheel, it was a great privilege to host you. And thank you once again to all the participants for taking the time out and being a part of the CareEdge webinar. I shall now hand over to my colleague Mangesh for the closing remarks. Thank you once again.
Thank you.
Thank you, Rajashree.
Thank you, Rajashree.
Rajashree.
Thank you, Rajashree, for moderating the session, and Jatin for your presentation. Thank you again to all our guest speakers for their insightful views. It was a privilege to host you. And thank you to all the participants for taking the time out and being part of this webinar. For any further queries, feedback, or suggestions, please write to us at corp.com@careedge.in. Goodbye for now. I request the tech team to